Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Sonali, Basak, who's going to join us now to talk about the three big banks reporting. It feels like JPMorgan, though, really, when you look at the share price, taking the biggest hit, about 6%. She has been up early, bright and early this morning, tracking it all. She joins us here in studio. Sonali, you were up as the numbers were coming out and breaking it down. The three of them, I guess we should start with JPMorgan, because I do feel like investors, a lot of disappointment when it comes to JPMorgan, the bank we probably watched most closely.
Well, one thing that's curious is just how much the stock has been falling today, because it is the worst day it's having since March of 2023. And of course, for a firm that is still making about an estimated $90 billion of net interest income this year, you have to wonder whether the market is starting to recalibrate their excitement about higher interest rates and the potential for future net interest income for these banks. The question I keep asking, is this a general feel that the market is tapping out, that the consumer is tapping out and can't really borrow that much more on credit cards here? Because remember, the American consumer is already sitting on a record mountain of credit card debt of more than $1 trillion at record high APRs.
So there's a point where that taps out. You would assume.
You would assume. You know, the thing that JPMorgan said about this was that you have many consumers, wages are keeping up, they're still spending. Spending is at levels roughly about where it was last year. Right. But lower income consumers are starting to feel some stresses. And remember, this is still a strong economy. All the economic data has pointed to strength in the labor market and broadly strong growth. But inflation is going to take a bite, and eventually interest rates will too. So at what point does Main Street start to catch up to Wall Street? You're seeing the stock reaction, even with the core Wall Street businesses meaningfully bouncing back. Investment banking is coming back. Trading beat estimates for Citigroup and JPMorgan. But you have the market, and again, remember, it's a tough tape out there. It is a really tough
market. But they were down out of the gate this morning.
They certainly were. And remember, another thing about this is JPMorgan going into the season was trading at the best price to book multiple. So perhaps investors now taking some chips off the table as they digest this news that was not as great as what they wanted for net interest income.
Not as great, but fair to call any part of it a disappointment? I mean, the stock reaction today would indicate that there is some disappointment.
Yes. Well, the big thing was twofold. One is that they did not raise their guidance for net interest income. Remember, JPMorgan, it has had such a run-up because it had 6 consecutive years of record revenue. So always the question is, what's next? What more can we get? The other problem is on expenses. They raised their expectation for the year's worth of expenses. It's a weird one, right? Because JPMorgan is one of the banks that actually has increased headcount, whereas many are shrinking headcount. And so they have an FDIC assessment, they have costs tied to compensation, technology, and marketing. On one hand, JPMorgan spending means JPMorgan fighting to be competitive and stay in the market. But on the other hand, inflation, costs are up.
All right, let's talk about Citi, because Citi initially out of the gate, we saw gains and actually a rally here. Talk to us about Citi, which showed a profit beat.
Unlike JPMorgan, Citigroup really entered the season with really the toughest valuation. They were trading at roughly 60% of their price to book value. So pretty cheap here. But you have Jane Fraser really showing her ability to be relentless. You love that word. It was the first words they used in their presentation, relentless execution. You're seeing that because the first phases of the job cuts that they've done and the managerial changes, which were significant.
Right.
Thousands of jobs.
Big changes that Citi's been doing by Jane Fraser.
Massive changes. And remember, this is a big ship to move. Citigroup was the second largest employer of the biggest banks. Tens of thousands of jobs more at Citigroup than there were at Bank of America, for example. It was the second largest behind JPMorgan. So for them to have already made these cuts and have said, hey, the progress is there, we've done it, now let's you focus on other things at Citigroup, which includes trading, investment banking.
Okay, what about stuff that comparing to JPMorgan, net interest income at Citi, for example?
Listen, it was stable. Something you have to think about here is as we kind of turn, the provisions for loan losses, I think this is what you might have been alluding to earlier, both at Citigroup and at JPMorgan were less than expected. So credit quality is really holding up.
Well, that's what I found interesting about JPMorgan's results. They ended up essentially saying, okay, lower income consumers, they're not that they're taking on more credit, they're actually just pulling back on spending. That's what we're seeing, at least.
Yeah, they're pulling back on spending, and really, it depends on how you look at it also. If you look at Citigroup, for example, the branded card revenue was not up by that much. And remember, Citigroup has a massive credit card business here as well. The other area where you saw just a bit below expectations when you came to Citigroup was this wealth business. And the reasons they attributed that to was a decrease in NII, net interest income, also affecting wealth business now, lower deposit spreads, and higher mortgage funding costs. So wealth is a big focal area for Citigroup, but it also shows you even in the wealth business, when you think about lending, these are wealthier consumers, right? There are even some questions there.
How much of Citi's earnings beat was just because they have been cutting costs so much and we're starting to see the impact of that?
Well, that's one big thing, but they also beat on some pretty remarkable businesses. That is fixed income trading, equities trading, and in underwriting in investment banking. And the reason that's so remarkable is because they've changed the leadership at each of those businesses. Coming out of the pandemic and when Citigroup was really grappling with a lot of regulatory changes, a lot of folks on the street were really worried about how much balance sheet they'd put to work. Jane Fraser is saying, we still got it. And so for her to turn around those businesses in the middle of, frankly, a lot of change at the top, including at those very, very businesses. Some people have not even taken the roles yet, Carol.
That's
and
interesting.
She's still beating.
What do we need to know on Wells Fargo, just quickly?
Same kind of story here. Where do they get that NII from? It's why you're seeing the weakness in the stock.
There's a theme.
There's a theme here. And again, this is going to follow us through. If you looked at it, really the whole KBW bank index.
Yeah.
I think maybe now the whole thing is lower. Citigroup was one of the only stocks outside of State Street up on the day. But we are
23 or lower, one gain. Yeah. So you've got, State Street.
And they had positive results today also. And again, a different type of NII trajectory there. But for the most part, people are worried about how this is going to feed through the banking system.
Shares of Wells Fargo down 0.3%, kind of bouncing around all day. Any concern about charge-offs for commercial real estate at Wells Fargo?
So remember, this is something they've been talking about for a long time. So you have to assume at this point that people have really priced a lot of that in. And remember, you have to look at the general percentage you're talking about for commercial real estate relative to the entire loan book. And that's going to get much more severe when you get to those regional banks.
All right, good stuff as always. Can you give me 30 seconds on Morgan Stanley? Anything we need to know about this investigation real quickly?
What will they say about it? They've been very silent. And the longer they're silent, the longer there are questions.
All right, it'll be interesting on the earnings call. No doubt about the focus has shifted. All right, Sonali, Basak, thank you so much.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, it's been a most read story on the Bloomberg all day today. It's a Bloomberg exclusive reporting on how Israel is bracing for a direct and unprecedented attack by Iran on government targets as soon as Saturday, tomorrow. This is according to people familiar with Western intelligence assessments. It's a move that has the potential, Tim, to trigger an all-out regional war.
Yeah, as Charlie just mentioned, we've seen markets move on this news, oil moving higher as well. With us, we got Hagar Chemali, who spent more than a decade in the U.S. government working in national security and public affairs. She's founder and CEO of Greenwich Media Strategies, joining us from Greenwich, Connecticut. Hagar, good to have you with us this afternoon. In terms of an increase just in this war, an increase in escalation, what would that mean if we did see Iran do an unprecedented attack on parts of Israel in the next few days?
Well, it would be a very significant escalation, to say the least. And I want to note that I am not an alarmist. I've worked on numerous crises in the Middle East specifically, and this whole time for the last 6 months have been saying, don't be alarmed by that. Don't be alarmed by this. That's not going to be the thing that triggers a region-wide war. But an attack by Iran proper, meaning not its proxies, not Hezbollah, not Hamas, an attack by the Iranian government inside Israel's borders would not only escalate things between Iran and Israel, because Israel is certainly not going to sit back and not respond to that, whether or not, however this was triggered. They're not going to sit back. That's not part of Israel's military playbook. But on top of triggering something wider between Iran and Israel, Israel is surrounded by enemies, including many who are backed by Iran, obviously, and armed by Iran, like Hezbollah. The IRGC is sitting in Syria, Hamas, and so on. They're surrounded by these enemies. But the fact is that Israel is an ally of the United States. And so, but when you have the United States going out there and saying, trying to share this intelligence publicly. That is a strategy on the part of the U.S., in particular the Biden administration, by putting this out there, is to put Iran on notice, to say the U.S. is watching. Don't forget that the U.S. could also come to Israel's defense.
All right, so we have talked, Hagar, a lot about how Iran has kind of, like to some extent, that the U.S. has been distracted by the war in Israel, between Israel and Hamas, because it's allowed it to do what it needs to do with Russia, whether it's sending oil, and it's gotten kind of the Russian-Ukraine war kind of off the focal point, if you will, when it comes to geopolitics. Having said that, does that tell you anything about what Iran might want in terms of, or how severe a response that they might do in terms of retaliation? In other words, might they be like, okay, we like that the U.S. is distracted, but we don't want to get into a confrontation with the United States?
Well, you make an interesting point. As a rule, these dictators like the one you have in Iran, China is the same. They like when the United States is distracted by another war like that one in Ukraine, because they know that U.S. resources are going to Ukraine. But as a result, I mean, the U.S. government can walk and chew gum at the same time. And the Middle East is obviously right now consuming a lot of the U.S. attention and resources anyway. Iran has two main goals, and its main goal on one hand is, it's a really one main goal, which is to expand its influence across the Middle East, to really be the one in power, to be the regional hegemon. And U.S. presence in the Middle East is a big pushback against that. So they want U.S. presence out, and they view Israel obviously as an extension of the United States, which is absurd, but that's how they view it. And that said, Iran knows it's not going to win a war, not only with Israel, but it's not going to win a war with the United States either, which is what has tempered Iran so far, and why Iran has relied on its proxies, because they don't want typically something direct. And you can see that play out not just in the last 6 months, but in history over and over and over again. Let's not forget, the Trump administration assassinated Qasem Soleimani. That is way bigger than the commander who was killed in Syria. And Iran vowed to retaliate. They plotted these assassination attempts against former Secretary of State Mike Pompeo and the former ambassador to South Africa, Lana Marks, and the plots were thwarted. And that's because Iran is very unsophisticated in its implementation. Now, you don't want to play that hand too hard, because they could get lucky. But that said, Iran does tend to understand its limitations, and does not want to protract and fall into a massive war where they go to the United States.
They don't want a World War III?
That's right. They don't want a World War III because they would lose.
Okay.
Well, that said, Hagar, and I know you said you're not an alarmist by any means, but help us game this out, given your experience working on this stuff. Let's say there is an attack on Israel over the weekend or in the next few days. What would be a way that Israel's allies, perhaps including the United States, could respond?
Well, one of the first things you'll see is Israel will likely respond in kind with attacks on some kind of Iranian military infrastructure, whether it's within Iran's borders or not. But I mean, if I were Israel and knowing Israel's military playbook, Israel has never been the kind to just sit back and respond in a way that comes off as though it's a weaker response. So they would, if Iran attacks Israel within its borders, Israel will attack Iran within its borders, and probably something in kind like a military infrastructure or something like that. At the same time, though, what you're going to see is the U.S. probably deploy warships in the Mediterranean, in the Persian Gulf in particular, to tell Iran, hey, don't let this escalate further, because we, the United States, could get involved. We don't want to get involved. And you've heard the administration say that talking point over and over again, right? We don't want to expand the war. We don't want to make this wider. But the U.S. also, this is an ally of ours. And while that alliance it is not written that we would come to Israel's defense, it's really more based on a calculation. If it seems that Israel's survival is at stake, then the U.S. would come to its defense. And that's the message the U.S. is going to try and get across.
Hagar, what about other Iranian allies? What about other players or countries or agents, if you will, in the Middle East? How they might react as well?
At the moment, the only one really that poses a significant enough threat to Israel that could take on this fight for Iran is Hezbollah in the south of Lebanon. But again, what you see so far, and I would expect you see maybe an increase, but then it would die down again, is because you've seen these strikes going on between Hezbollah and Israel back and forth. And the reason it hasn't escalated to the point to a full-out war is because it is in both sides' interest not to have it escalate to a full-scale war. And that's kind of what I expect now is that Iran, if Iran indeed does go through with its strike, which the U.S. has put out there very loudly, then I would expect Israel to respond and the whole world to communicate to both. Okay, now you've responded to this situation. Now please let the tensions calm down a bit. And we have seen Iran respond to that. When the U.S. struck 85 targets 2 months ago in Iraq and Syria against Iran-backed groups, Iran told those groups to cut it out, and they did. So Iran is aware of its limitations. So it wouldn't be surprising if you see things escalate. If Hezbollah goes crazy and takes this fight on, that's where you could see this escalate very widely. But all the parties have an interest in doing something, but not letting it get out of hand.
One thing I want to ask you, and I just want to take a couple of steps back, if I may, because what set this off in motion is Iran saying that Israel was responsible for the attack on the Iranian embassy in Syria. We were just talking, I mean, if that's the case, right, I'm not quite sure that it's truly been confirmed, but having said that, why would Israel have done that? Did they know? Were they looking to kind of, poke around? Like, why would they have done that?
Well, so a few things. So, right, it hasn't been confirmed yet, but it wouldn't be surprising if it came from the Israeli government. But it's also the thing, to be honest with you, I have been surprised, having worked on the Middle East for so long and having dealt with these wars. This is a pattern of behavior that we believe the Israeli government has pursued, including within Iran's borders. There was a scientist who was assassinated only a couple years ago that was assumed to have been Israel. And it was, again, neither confirmed nor denied, but it was so sophisticated, the attack, that many people believed it was Israel. And so this one, I understand, is a diplomatic compound. But how that's different from Iran's borders, within Iran's borders, I don't know. And again, assassinating Qasem Soleimani, that was a significant move. This is the man who has been behind the terror in the Middle East for the last 30 years. And that was even more significant. But this one, sorry, continue.
No, bottom line, because we're just running out of time. I mean, 20 seconds. Nonetheless, you're unnerved. You're a little bit on edge because of what's happening. And someone who's watched the region for a long time. Yeah.
Yes, I would say an Iran strike on Israel makes me unnerved. Yes, it is. I'm not alarmed. I'm not alarmist, but it would definitely be a significant escalation and very, very risky.
All right. Really appreciate you weighing in. Hagar Chemali, she's founder and CEO of Greenwich Media Strategies, joining us here on Bloomberg Businessweek.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, among our most read stories on this Friday is, of course, what we just talked about, how Israel is bracing for an unprecedented direct attack from Iran. Stocks here in the U.S. definitely under pressure because of those war jitters. All of this happening as we kicked off today another U.S. earnings season. There's a lot going on, you know that, with the big banks reporting earlier this morning their commentary and those from the C-suite to come as we go through the quarterly earnings season here in the United States, what they say about the economy, what they say about the outlook in markets. Tim, that's going to be really important.
Yeah, with more on the C-suite view and priorities and stresses, back with us is Rich Lesser, Global Chair of BCG, also known as Boston Consulting Group. He's here in our studio. Rich, good to have you with us this afternoon. Hey, before we get into the three big challenges that you see global CEOs having right now, weigh in on geopolitics, because certainly front and center today, and I think no question, a lot of business leaders are thinking about what's happening around the world right now.
Absolutely. And I would say it's not just today. You obviously see it today in the stock market data and other things, but and the stresses, but it's been this whole year. I've talked to a lot of CEOs, and it's interesting how much risk has flipped over the last year. If you go back a year ago, people would have said the first risk was the macro economy, inflation or unemployment risk, recession. The second risk was U.S.-China and a deteriorating relationship. And the third was geopolitics and politics more generally. A year later, it's upside down. The top of the list is politics and geopolitics, two wars that seem intractable right now. U.S.-China has dropped, but has at least plateaued. So it's still a big concern, but it's at least a bit more stable than it was. And the macroeconomic risks are still there, but in a much narrower range now, I think people are feeling than a year ago. So you're right. What's weighing on companies right now are things that are really beyond their control around what happens in this political situation, what happens in these wars, geopolitics more generally.
Listen, CEOs are trained and paid to deal with stress. We know it, right? And when it comes at them from all levels. But would you say that CEOs in the C-suite is more stressed or are more stressed than they were 6 months ago or a year ago? Or you can
I would say this whole decade has been one source of stress after another.
Yeah.
To me, the really interesting comparison is we've almost come to expect this level of uncertainty and disruption and risk, starting with COVID and supply chain and inflation and U.S.-China and wars and now all the political division. I think CEOs forget how much, not that it was easy, not that there weren't challenges, but how dramatic a change this is in the dynamic nature of the range of risk. And then you've got other challenges like climate change and other things over the last 4 years.
Well,
okay, go ahead, Carol.
No, I was going to say, because you've been kind of thinking about what's top of mind when it comes to CEOs. Walk us through some of them, because I know you shared some of the notes. Something we talk a lot about is generative AI.
For sure.
Is that really, top of mind? I feel like it comes up in every conversation. I feel like it's safe to say that the C-suite and others are really still trying to figure out what it means for their businesses. But how are they looking at it?
So it is top of mind. I would also highlight that a lot of them are still trying to figure out how to ensure in a world where they have less pricing power, where growth still is okay but not great, they create robust near-term businesses. But generative AI is just hanging out there as the fundamental change on the horizon. And it's only been a year and a quarter since this technology really got highlighted as a huge opportunity. Right. So many are still in a learning mode, but that learning is shifting from learning what the technology is to learning how to drive fundamental impact in their businesses. And that's a different question. And what we're seeing is people are increasingly recognizing that the tools, the generative AI tools, are powerful, but if you're going to have business impact that's powerful, it's about combining multiple things together. You need those tools, but you need predictive AI, you need proprietary data, and you need a massive focus on the people and organizational aspects of this change process. And just the tools alone get you 10 or 20% productivity, but you need to get the 30 to 50%, you need to put a bundle of transformation elements together to get the true value and potential out of those. Sounds like
they're trying to figure out a lot of stuff.
Well, that's what I want to ask you, because this is something that we talk about all the time, which is, okay, we've all played around with ChatGPT and the image generators as well, but I want to see how this affects how companies are using this to pad their bottom line or increase efficiency or come up with new products and services, and I just haven't seen that yet.
Oh, I think we're really starting to see it. If I take the insurance claims processing area, most, and what you can do to take what were 10-day processes to review claims and approve them down to a day. If you
I will say they are not passing those savings on to customers right now with insurance prices.
And I'm not promising where the savings are going to go. Like, that's a separate question when you get the savings. But I think whether it's insurance claim processing, whether it's clinical development, report writing or designing a protocol for a clinical trial used to take months and months. You can take massive amounts of time out of that. When you look at software writing, only 30% of the software companies were using sort of the GitHub type capabilities that exist. When you input those in, all of those are 30 to 50% productivity opportunities or more, but only if you combine the human aspects of it, you put some predictive AI alongside the generative AI, you leverage your proprietary data. It's not just a simple hand people a tool and savings pop out.
I want to get to an aspect that's also, you say, top of mind and top of the agenda for CEOs right now, and this has to do with cost management as a lever for transformation. And what's interesting is you get into, I think we talked about Citigroup, right, going through transformation. They've let go a lot of workers as well, but that things like physical downsizing, headcount reductions rarely generate sustained savings or growth because companies are not addressing the root causes of cost creep. And that according to a recent survey that you guys did, 34% of executives said that freed costs crept back within 12 to 18 months. So, all right, what is the cost management or cost cuts that are transformative for a business?
I think I'm so glad you raised that. There's this classic approach, tell everyone they need to take out 10% or something. And what we see over and over is when you just give people a target and say hit a number, they find a way to hit a number, but they hit it in ways that are not sustainable and it creeps back in. If you want to make this real and lasting, it's much more of a fundamental look at what are the dynamics in the organization, where is there work happening that doesn't need to happen, where do you embed tools and technologies, not just generative AI, even traditional technology and digitization tools that allow you to rethink processes, take on harder topics like supply chain and manufacturing and procurement, not just, administrative overheads.
So really thoughtful.
And use that. And those more thoughtful approaches are not just more impactful, they're much more sustainable and often create revenue opportunities too.
Yeah.
Because too many layers in an organization is not just about cost, it's about slowing down innovation, stifling, change from happening.
Rich, we only have 30 seconds left, but give us something on climate change and the way that you think CEOs need to prioritize this.
Well, first, I came back from the West Coast. I've been there 2 weeks. The number of exciting climate technologies that are coming forward right now is really great. It's a different discussion. I know we don't have much time. I think this will be a quieter year for new announcements given the elections underway, how divisive this is becoming. So right now, CEOs should be obsessively focused on how they're going to deliver on the commitments that they've made and where they can go further. And probably the announcement parts are going to wait till after we get through this election season.
Really interesting. And maybe we bury the lead because I do feel like if we don't get climate under control, many would argue, right? You don't get that under control, and not much else is going to matter. Rich, thanks for stopping by. Really appreciate it. Rich Lesser, Global Chair of BCG, of course, Boston Consulting Group.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Last month, we reported on how billionaire Steve Cohen's Point72 Ventures. It's part of a group of investors who are betting that blockchain tech can be used in the U.S. to simplify vehicle registration. So Point72 Ventures led a funding round for a company called Champ Titles, Carol. It's a startup that's working with several state governments to replace existing vehicle title registration and lien systems with a digital system featuring blockchain technology.
Cal, sign me up for someone who has to go get a new title or replace another copy of a title for a car. Yeah.
Yeah. I have to
dreading.
I have to find my marriage certificate.
Really?
Yeah. I don't know how I'm going to do that. Yeah. It's very weird.
Good luck. Blockchain, it could come in handy.
Yeah, hold on to your marriage certificates. I'll say that.
For advocates of the technology, car registration, just one of many uses, but we think about this a lot. This is blockchain I kind of understand. John Wu is one of those advocates. He's president of Ava Labs. He's the developer of blockchain project Avalanche, and he argues that we'll soon see quick adoption of blockchain technology. He joins us from New York. John, good to have you on with us again. So how are we thinking about blockchain? What are you seeing in terms of it really being put to use? Because I do feel like we have been talking about it for a long time. I'm going to say at least a decade already.
Well, it probably is about a decade, but probably a little bit less because the programmability on using a smart contract on a blockchain really started with Ethereum. So, Bitcoin is not as programmable. It is really more of a store of value. And Ethereum's only been around for less than, call it 10 years. So that's when it's really started happening. But utility is hard to understand because there's a lot of B2B stuff. And even what you just mentioned with the DMVs having cars register on a blockchain, that's a use case that makes perfect sense. That's the blockchain aspect of it. And I think the states that is leading the way on that is state of California and their DMV. They are really, I think they already said they want to put all the title of cars in California on a blockchain within a very near term in the future.
Hey, so how is that different, John? Explain to someone listening right now who's saying, wait a second, how is that different from just, having a database in the cloud of every vehicle registration? Like, how is it different when it's on the blockchain?
So this database is shared by everyone. It's immutable, and everyone can see what's happening. So first of all, the reason to use it is it will save costs because you don't have to replicate databases for every point of access for every person needing their own version of the ledger, if you will. So it will save you the system money, if you will. It'll make the workflow far more automated and save excess, operating expenses in that way. But more importantly, I think in this case, the fact that it is immutable and transparent, it makes it easy for people to audit and check and the provenance of who owned what auto. What you are afraid of in this non-trustless world of single servers is that whoever has control of that server can actually change information on that server by accident or for nefarious means. On a shared blockchain, you can't do that because everyone can see what's happening.
Well, how would it work? So help us understand. So like, if I needed to get a copy, or I wouldn't have to get a copy of my license is what you're saying, or my car title, because it would just be on the blockchain. But how would I access this? And who would be overseeing that blockchain?
That's a good question. So that's the user side, the user interface side. I mean, you can also replicate this with your house titles, the same concept. Right now, when you buy a house, you need to change ownership. You go to town hall, and at town hall, it's actually paper-based, if I think most places, and they literally show you paperwork of who owns, and then they add your name to it. So the user interface in this case will still be controlled by, I guess, a municipality or a state, a public entity, so to speak. But the underlying information will be stored in a way that, in theory, all municipalities can all get access to it and look at it. And even I can actually look at it if I am savvy enough to create an interface to search into the blockchain.
Okay, I would imagine there are some more exciting uses for blockchain than DMV. But Carol wants to keep talking about it. Go ahead.
I just one more question. So
DMV is very exciting. Imagine if you save yourself time of going into doing all this stuff. I mean,
would it save me time? Would it save me money though? If I still had to verify something, would I still have to go to the municipality's blockchain or talk to somebody, and they would have to say, "Oh yeah, like it's here." Would I have that easy access or no?
Well, presumably it will save the municipality money to put it this way, put it on a blockchain over time. And whether they want to provide access to everyone, I think in this case, it's a hybrid solution where they still control some point of access. Okay. But if they conceptually wanted to open it up and expose the blockchain, everyone can see it.
So they could still charge me, basically.
Yeah, they got to get revenue from. They got to pay.
Looking for seamless.
Got to pay all those employees.
Taking costs out of the equation.
Yeah, not like we talked about earlier. Maybe the savings aren't being passed along to the customer.
Maybe not.
Okay, John. I want to talk a little bit about some other use cases here because you argue that we could see lots of uses when it comes to gaming, consumer loyalty, and on-chain finance. I want to start with on-chain finance here. Explain to us because this is not just something that you're talking about here. I mean, we got BlackRock's Larry Fink talking about this as well. Tokenization. So talk to me about what's exciting to you when it comes to finance in the blockchain.
So the number one use case right now happening in the financial world is tokenizing of what I call real world assets. And that's either tokenizing money market funds, the US dollar, or actually a private equity fund. So I think the one area that people will absolutely agree that there's some product market fit, if not already has product market fit, is the stable coin. So even PayPal is trying to create stable coins. There's a lot of this happening in different industries. And in fact, I think Brevin Howard did this analysis where last year there were more stable coins settled on blockchain or as much as the Visa network. So basically, when you can create that efficiency, you save money. And even PayPal, they're allowing US customers using their stable coin capability to send money overseas. And when I spoke to them last, basically, if there's 4 parts of creating a stable coin, it's and allowing people to transfer the money around the world, they haven't even completely integrated the entire workflow. But yet, what they've integrated, call it half of it, has already makes it a more profitable transaction. Another great example would be sticking with PayPal. PayPal owns the PayPal wallet and Venmo. They bought in Venmo and Braintree. It's a different, construct, different tech stack. And if you have a wallet at PayPal and Venmo, and you have a PayPal wallet, if you want to move your own money, $100 from PayPal to Venmo, you see $100, so it's seamless to you. But in the back end, really what happens is it's subsidized by PayPal, and only 99.9 gets moved, and they put the extra 10 cents in there for you because they have to go outside the system, integrate different tech stacks, move things around, go to a third party, and it just costs money and the friction there costs money.
Yeah, I would assume that whole industry, right? We know they're looking and watching because you just think about how much. I've got a daughter overseas, and just the movement of monies and the mechanics
that is
between
so hard to do.
Bank here and opening a bank there because it makes more sense. Like, it's just crazy. And she's become real savvy about who's charging fees and stuff, and we try to figure it out.
You just got to do it in Switzerland, Carol.
We're on Bloomberg right now.
Well, I mean, if you remember, like 5, 6, 7 years ago, people who did remittance was using Bitcoin, because it was save them 15% instead of going to Western Union or one of these places.
Right.
The only problem with Bitcoin was just too volatile. So now the stablecoin construct is a better one for moving money back and forth overseas.
Well, John Woo, I can't wait till I don't have to go to DMV anymore. Sorry, DMV, but there's got to be a better way. And I understand how maybe blockchain can make it simpler and make more sense. John Woo, thank you so much. Have a great weekend.
John Woo also big on Twitter. I don't know if you saw, he tweeted, when he tweets, mentions you on Twitter, you get a lot of responses.
John, can you mention us a lot more? We would really appreciate it.
Absolutely.
Thanks, John. Good to see you.
Be well.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just about 18 minutes left in today's trading session. Charlie, of course, just breaking down the numbers here along with Bill Maloney. We've got stocks pretty much at their lows of the session, but some of the definitely a risk-off trade, certainly on the equity side of things, but I feel like some of the safe haven trade, we've seen that dial back a little bit.
Yeah, we got a great guest. Let's drive to the close with JJ Kinahan, CEO at IG North America. It's the parent company of the options, futures, and stock trading platform Tasty Trade, as well as the global Forex trading platform IG. He's here in the Bloomberg Interactive Brokers studio.
We wouldn't let him leave.
Along with Bill Maloney, technical analyst at Bloomberg, because sometimes you just got to have Bill Maloney stick around.
Well, we just kind of wanted a roundtable because it's been an interesting day. And JJ, let's bring you in first of all. In terms of, we've seen pressure, we've been talking about geopolitical concerns. How do you guys see it? How are you thinking about what's happening today?
Well, I don't think it's, it started obviously with Mr. Diamond's statements this morning, I think, which took everybody by surprise in terms of the fact that, normally CEOs say, hey, here's our one standard deviation plan in terms of there's one or two things out there that could give us some headwinds and we're planning for that. Basically, he said today, there's like 7 things that can happen and we're not sure which one to plan for. So that threw the market off a little bit to start. And, we've seen sort of a follow through with different geopolitical news, et cetera, is one of the things he brought up as a risk overall. In general, I don't think this is unhealthy for the market to have a bit of a sell-off. It's where it goes from here that really matters.
So, Bill, come on in on it. You've been watching it kind of, I don't want to say tick by tick, but it does feel like tick by tick that you do. The moves that we've seen, because it wasn't so negative earlier this morning or pre-market.
Well, it has been a tick-by-tick day, and the only time people want to talk to me is on days like today. But the one thing I will note with the S&P is testing and thus far holding its 50-day moving average, and that's the first time since, I think, October, November. So the 50-day moving average down to 51.11 right now. It's at 51.20 is the key level today that we're watching.
All right, so we're right at it.
And we're right at it.
So, Bill, what are the folks who are getting in touch with you asking? What do they want to know?
Basically want to know is where the buyers might step in. And right now the 50-day has been, we took out some key levels earlier this morning. Yesterday's low and the day before, which was Wednesday's low, that was key support. That fell. When it fell, it went right down to the 50-day, and right now we're holding it.
Well, speaking about buyers coming in, we've been talking a lot about JJ Apple, and buyers moved in a big way yesterday. We've talked a lot about our Mark Gurman story, but would you suggest that investors, as we see this little bit of a pullback, start to step in?
It's really interesting. If I look back to 2020 and in the dip, if you remember the buy the dip mentality every time we went down, it always started with Apple and Microsoft. What's really been interesting to me is over the last few times, it has not been Apple. It still continues to be Microsoft. Yeah. It's actually been Microsoft and Meta where we see people go to. So I think it's very interesting
when they dip lower.
When the buy the dip mentality takes over, those are the two stocks people tend to start with. This is the first time we've seen Apple be one of those stocks in the last 16 months.
So what's that telling you?
What that tells me is that perhaps the fear around Apple is a bit overblown in terms of maybe some of the things we're seeing in China, particularly on the back of the news is what is happening to the chip makers. Maybe Apple isn't going to be alone, and that might be okay for them longer term. And also, at the end of the day, Apple's still an amazing franchise, and people are still going to step up in there.
JJ, that news you're referring to,
amazing franchise and a great balance sheet.
We're seeing chip makers lower today as a result of a Wall Street Journal report that said that China has asked its telecom carriers to start phasing out foreign chips.
This is something you've been watching or
right.
talking
So
about.
AMD is very weak today. Intel is down 5 or 6%. So the chip makers, NVIDIA is down big as well. So they're all weak today, basically off the headline. They all started moving as soon as that headline hit, probably 3 or 4 o'clock this morning.
What are we looking at in terms of the stocks right now? And let me just pull it up real quickly. I mean, we've got the stocks down almost 3%. So it's pretty much, it's a little bit off its lows. It was down 3.5% its lows, but nonetheless across the board here.
And that's something you may find buyers pop in. Like if there's nothing, if the weekend is quiet, there may be some buyers on the open on Monday.
What do you make of, Jess Menton was in earlier, our deputy team leader for U.S. equities here at Bloomberg. She said the S&P 500 on pace for the worst week in 2024. You mentioned about 5120 on the S&P. This would be the worst week since October 27th, 2023, which is when we saw kind of stocks take a recent low, right? And from there, we were up about 27% from that October low till now. So if it is the worst week in 2024, what's the significance of that?
I think Bill hit it right on the head. What happens this weekend? If it's a quiet weekend, you have to remember one thing. We're seeing VIX still up over 25%. It's still below. That's exactly my point. It's still below 20.
Yeah.
It's not flashing a terrible warning sign. It's saying, okay, we had a sell-off for the first time in God knows how, since October, really, of this significance.
Right.
So the market probably, to stay healthy, needed a bit of a sell-off. If we do break, as Bill talks about, this 50-day moving average into the close, that would be a really bad sign. Or if we have some bad action this weekend and we start on a very negative note on Monday, that would be a bad sign. But if we hold that level and the weekend is relatively quiet, I think it's probably one of the really healthy things for this market.
Bill, how do we know if this sell-off is actually the start of something bigger or if this is just a temporary pullback?
Well, we've been weak all week, right? So, and I want to see the S&P hold the 50-day moving average. You know, we talked about Apple. There's a chart that I wrote about last week on how Apple was testing relative to the S&P. You talked about the level back in October.
Mm-hmm.
It tested there and had a rip your face off rally this week off that level. So that is a key level we're watching in Apple, how it trades relative to basically the S&P. And right now it's acting very well. It's one of the best performers today. It's still up, I think.
It's interesting.
Can I say one thing,
yeah,
Bill?
please.
Every trader loves that you just use the word "rip your face off." Every trader uses that expression, and every trader loves that expression.
Hey,
not quite
JJ,
a Bloomberg function yet, but
I do want to get into a few of the stocks that you sent our way because you have a great view on what whereas there's bullish and bearish activity. You mentioned Meta Platforms. Still seeing bullish activity there.
Well, all this week we have seen Meta be one of our more bullish stocks. You know, normally if you look at retail flow, retail is about 55% buys, 45% sells. I don't know, it's still pretty close to 50-50 actually.
Yeah.
We have seen 75-ish, 80% almost of Meta activity over the last week be bullish activity. So that's really unusual. When you get above 60 to 65% buying activity, that's also unusual. And we've seen that. The two stocks that stood out for me were that and GE. GE has been for almost 3 straight weeks. People cannot get enough GE.
Wow.
I have to say that I do,
Blast from the past.
I have to pull up the gainers, and GE has been up top that list.
What's old is new again?
And all the industrials have been great, but GE in particular, what do you feel about the spin-offs?
And GE Vernova is the other one, too.
GE Vernova had a great week.
Yeah.
Talk about the parts being greater than the sum. Look at GE Healthcare.
Right,
GE's
Healthcare,
doing well. GE Healthcare has been a dynamo since it's spun off. So all of the parts are doing well. So, I mean, was it mismanagement? Was it that they were so big it was just hard to manage? Whatever it may be, this looks like it was a really good move to break up these things into different areas.
Maybe investors just kind of really want to understand what a company is. And I feel like that clearer, cleaner vertical play sometimes makes sense in terms of an investment thesis.
Absolutely. I think the company that has headed maybe that way but is still a dynamo is Amazon, because there's a business there that's always doing well.
Real quick, if we see buying to the close, which we're starting to see, is that a good sign?
Yes, absolutely.
Bill Maloney?
Same here.
All right, we'll see what happens, folks. Got about 10 minutes to go. Thank you so much. Our own Bill Maloney and JJ Kinahan, Chief Executive Officer of IG North America, in the house. This is Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.